Today, I'm going to be talking about the tax reliefs that are available to a business's investors that can be used to incentivise them to invest in your company. Now, the most well-known and valuable of these are the Enterprise Investment Scheme and the Seed Enterprise Investment Scheme. Very valuable reliefs, used a lot of the time, but plenty of pitfalls for the unwary. So getting the right advice is key. And so today we're going to look at these reliefs. We're going to look at some of the things that can actually go wrong to try and help you to avoid that. And we're going to look at one or two other reliefs that are available along the way. For those of you who don't know me, that's me, before the lockdown beard got to me. So I'm a partner in our corporate and business tax team, dealing with a huge variety of clients and different problems. So, EIS and CDIS, what's it all about? Well, to start with, what's it actually worth? In the latest available figures for us, 2018-19, HMRC tells us that nearly 4,000 companies used EIS relief to raise funds, and that raised £1.824 billion. So there's a lot of money involved with this. It's a very valuable relief, and perhaps it's understandable why there are plenty of caveats and pitfalls to actually securing it. CDIS came along much more recently than the main Enterprise Investment Scheme. It's aimed at smaller businesses. We'll come to that in a moment. It's much more restrictive in terms of the numbers, and therefore, even though around 50% of the number of companies actually used it, the funds raised were only £163 million. So it's not as big a deal in the overall scheme of things, but it's very important to those companies who use it. Now, not everybody is going to understand what these reliefs can actually do for your investors, but I would say that they really work some magic in terms of the risks that they're taking in investing in unquoted trading companies. So let's look at them in turn and try and put some figures on what the reliefs actually do for them. So if we start with EIS, the Enterprise Investment Scheme, fundamentally, it's a tax relief for qualifying share subscriptions. And subscriptions is the key word here, because it's all about raising money for the company. So you cannot access EIS relief if you buy second-hand shares, if you like, from somebody else. It's always subscribing for new shares from the company. Now, if you qualify, then the individual will get a 30% income tax relief. So if they spend £10,000, in theory, they get income tax relief of £3,000. What's important to remember for them, especially if they're investing larger amounts, is that that tax relief only comes by reducing other tax liabilities. So they have got to have a high enough income tax bill the year in question to be able to use the relief. But the income tax relief, which is perhaps the headline thing that you'll see the most, is not the only tax relief that we get, because we also get a CGT deferral relief. So actually, if I had recently sold my business, let's say, and I had crystallized capital gains tax on it, if I put some of the proceeds into an EIS qualifying investment, I can actually defer the capital gains tax on the disposal of my business shares or part of it until I dispose of the EIS shares. Now, I'd have to think very carefully whether that was something I wanted to do or not, because at the moment we're in a period of time where capital gains tax rates are low. I might be qualifying for business asset disposal relief, that was entrepreneurs relief, on the disposal of my company. And therefore, I'd have to think carefully, do I actually want to defer that tax and risk tax rates increasing by the time it crystallizes, or do I just want to pay it up front? But it may be other things. It may be that perhaps I've sold residential property. That carries a higher 28% capital gains tax rate. It'd be much more logical to want to use the deferral relief. Moreover, if my EIS investment is successful and I eventually sell the shares for a profit, if I've met the conditions for a period of at least 3 years, so I've held my shares for at least 3 years without a disqualifying event, then I've actually got a complete CGT exemption on the disposal, which again can be very valuable if the company has really taken off and I'm making a substantial profit. On the other hand, if things go very badly and I make a loss, there's a further income tax relief that I can claim. And we'll see an example of that in just a minute. And finally, an EIS company being an unquoted trading company should be a trading company for inheritance tax purposes. So if I've held that investment for at least 2 years and then I die, I should find that business property relief protects that investment from inheritance tax. Importantly as well, going back to say the sale of my business property relief has rules surrounding replacement assets. So if I sold my trading business, my trading company that I used to get business property relief on, I'll turn that into cash. That would give me an inheritance tax problem. Actually investing that into EIS shares, I immediately get the business property relief if I tick the boxes, because it's treated as a replacement for the business asset that I had before. Of course, all of this needs carefully weighing up against the risks of the investment that you're actually going to make. So I'd never be saying to clients to make these investments purely for tax reasons, but they certainly get tax benefits and it lessens the blow of the risk. So let's see that in practice. So under this illustration, at the point of my investment, I invest £10,000 into Moody Limited under the EIS. What do I get? Well, I get 30% income tax relief. So I get £3,000 taken off my income tax bill for that year. The net cost, £7,000. What happens next depends whether the business is successful or fails. So if we get success, we see that the shares are actually sold for £100,000 after 3 years. So we've done very, very well. The company has pulled it off. I've had the shares for more than 3 years. There's been no disqualifying event. So I pay no capital gains tax. So actually I've made a post-tax profit of £93,000 because there's no capital gains tax at all. But what if the company fails? Well, if the company goes under, then I can claim a further income tax relief on the £7,000 that I've lost. I know it feels like I've lost £10,000, but I've already had £3,000 of that back as income tax relief up front. So it's only the £7,000 that I claim. Now, if you work that through, if I was a 45% taxpayer, that actually reduces my overall loss to just £3,850. So I can actually look at it that this £10,000 investment I'm making isn't really a £10,000 investment. It's cost me £7,000 in the short term, but actually I've only really got this £3,850 at risk because of the way that the tax rules work. Very valuable. And when you're trying to get investors to invest in your business, if they realize they can take advantage of this, it makes a big difference to them. The seed enterprise investment scheme, as I said, it's for smaller companies, and we'll look at what we mean by that in just a minute. Very similar relief. A lot of the wording is the same, but the restrictions aren't quite the same, and nor is the tax relief. 50% income tax relief, but only 50% CGT deferral relief. Still get the CGT exemption on disposal, still get the further income tax relief if there's a loss, and the business property relief. So again, if the investment into Moody Limited was under the seed enterprise investment scheme, then actually my net cost up front is now only £5,000 because I got the 50% relief. And again, if the shares are sold for £100,000, after 3 years, no capital gains tax, post-tax profit, £95,000. But if the company fails, I've had a bigger slug of upfront income tax relief. So actually that reduces my overall loss, if I was a 45% taxpayer, to just £2,750. Starting to think about the difference between the two schemes then, we know that SEIS in most cases is likely to be more beneficial to the investor because of that higher upfront income tax relief. Unless, of course, CGT deferral is their main aim from a tax point of view with the investment. But there are very large differences in terms of the way that the two schemes are available. As you can see, under EIS, the maximum investment that can be made by an investor per annum is £1 million, and that's actually £2 million if the company is what's called a knowledge-intensive company, which really relates to what it's doing, the qualifications of the people doing the work, etc. Whereas SEIS, all they can invest is a maximum of £100,000. And the differences become even more stark when you look at what the company is able to raise. Because under EIS, we can raise £5 million per annum, or £10 million in a knowledge-intensive company. But actually, SEIS company can only raise £150,000 in total from the SEIS. And it also, as you can see, has to be a much smaller company, the maximum of £200,000 of assets versus 15 million staying eligible for EIS. Sorry, slightly behind with the slides. I'm looking at a different screen. So the other big difference is in terms of timescale. Under EIS, we have to make the investment, we have to receive the investment within 7 years of the first commercial sale. That's actually a relatively new rule, and it's caught some out because it didn't used to be that restriction at all. CDIS is within 2 years of the trade commencement. So SEIS really aimed at those early stage companies. Well, for slides this morning, aren't I? So, EIS, SEIS, what conditions do we need to meet? Well, we've got to have an unquoted company to start with, very important. Permanent establishment in the UK, less than 250 full-time employees or 25 SEIS. And we've got to raise the money for the qualifying business activity, which we'll look at in just a second. We've got to spend the money within 2 years. And that's important. That can be a problem, especially if you become profitable. Can you actually show that you spent the EIS money or SEIS money rather than the profits that you're making? Company's got to be solvent, and you genuinely have to have the capital at risk. You can't have a situation where there's some sort of contrived scheme to reduce the risk for you. So, as we said, the first investment has to be within that time frame. Again, new shares fully paid up in cash, ordinary shares with no preferential rights. So we do have to be careful in companies with different share classes, and the investor cannot have any connection with the company. That generally means not holding more than 30% of the shares, but there are complex tests in terms of directors and employees. And therefore, it's pretty important that those are looked at quite carefully. There are certain trades which don't qualify for EIS and CDIS. They're on the screen. I won't go through them in detail. interesting to see accountancy services down there, dealing in land or shares, financial activities. There's various ones there. In theory, these are trades that HMRC views as a little less risky. I'm not sure that that's true in all cases, especially in COVID times. But I think that's the logic for denying relief in these cases. We have found that sometimes you can get into a situation where there's a bit of debate as to whether something falls within these or not. So that's also worth taking advice on. Now, one of the things that a lot of companies will consider with EIS in particular and with SEIS is the advance assurance. So this is where we go to HMRC upfront. We set out everything to do with the company, and we basically ask them to confirm that the company qualifies for EIS and ticks all the various boxes. It doesn't confirm that the investor ticks theirs, but at least you can then go to your investors waving a piece of paper saying you should get tax relief based on our company. Now, that's always been very popular. In recent years, the revenue's got a little bit more tricky with this. They're sort of actively discouraging speculative applications by making sure that you have to, on application, either name your potential investors or name the organisation that's going to be raising the funds for you. Advance assurance, I've certainly seen some difficult cases over the years, especially perhaps where companies have tried to do the advance assurance application themselves, not necessarily describe things very well, and then it can be quite difficult to rein it back and get the inspector to change their mind. So it is worth taking some careful advice on that. After that, once the investment has been made, there's a procedure for actually claiming relief. And EIS1 is sent into HMRC with all sorts of information about the company and why you meet the conditions. They then issue EIS2 to the company, which allows the company to issue EIS3, and the investor claims their tax relief, usually through their tax return. But I did say that there were various pitfalls. So here, in a minute, we'll talk about EIS and the failed skydiver. So various pitfalls out there. Exceeding the £150,000 SEIS limit in a single day can be a problem. But in terms of our skydiver, it's this second bullet point, we must claim income tax relief to obtain CGT relief. So our skydiver, he was a self-employed skydiving instructor, teaching people to skydive, going down with them. But unfortunately, he wasn't terribly successful about it. And don't worry, this doesn't mean sort of unsuccessful skydiver in terms of a big red splat on the floor. Everything was safe, everybody was fine. But Mr. Ames, the skydiver, in the year in question, made a profit, grand total of £42, which, as the judge in the case that HMRC looked at, was well below the personal allowance. So what happened? Mr. Ames had invested in shares in a skydiving simulating company, you know, one of these big fans where you sort of go and you pretend that you're skydiving. So he'd invested in that. He would have been eligible to EIS income tax relief. But because his profit for the year was only £42, that was wiped out by his personal allowance, he didn't claim income tax relief. In fact, there wasn't really any way that he could claim income tax relief via his tax return because the personal allowance covered the income. A few years later, he came to sell his shares, and the company had done very well, and he made a capital gain. So, as I talked about earlier on, CGT exemption on selling EIS shares, you'd think he'd pay no capital gains tax. But unfortunately for Mr. Ames, the judge ruled that because he hadn't claimed income tax relief on the investment, simply because he had not enough income to claim it against, that unfortunately prevented him from obtaining CGT relief, which seemed unfair, but it shows the quirks of the legislation. Other problems that we see, not complying with the 7-year rule for EIS. As I said, that's relatively new. The exception from the 7-year rule is if you can show that the money is being used to move the company into a situation where it's supplying new products or markets. Now, I've experienced some difficult conversations with the revenue over this in terms of proving that they genuinely are new products and markets. So again, companies over 7 years old, you've got to tread very carefully. Now, the timing of the cash is very, very important because with EIS and SEIS, we have to have new shares which are fully paid up in cash on issue. And we can't be using shares to effectively repay a loan. Now, this makes timing and handling of the money very, very careful. And there have been cases that the revenue have taken both ways on this. So effectively, if you were to collect the cash and then there was a delay before you issued the shares, then the revenue might argue that the cash initially was lent to the company, and then actually the subscription wasn't paid up in cash. It was fulfilled by using a loan repayment, and therefore the shares don't qualify. On the flip side, if you issue the shares too early before the cash has come in, then they're not fully paid up in cash on the day that they're issued, and again, the EIS can fail. We've seen these cases out there. Now, technically, shares are issued on the date that they are written up in the company's statutory books. So the paperwork is very important, and we would always recommend that it's actually dealt with by having your solicitors deal with it, collect the cash into a client account, and releasing it to you at the appropriate time when the shares have become fully paid up. Other problems, you can't have a pre-arranged exit. That de-risks it so that somebody actually knows how they're going to get their money back. And we've talked about preferential rights and the connection tests. So that's EIS and SEIS. A couple of bits on other CGT reliefs for investors. Before I go on to that, I would just say you've got the question box within Zoom. If there are any questions you'd like me to answer at the end, do jot those into that in the next few minutes, and I will pick those up. But other CGT reliefs. Clearly, if we can get our investors into EIS or CDIS, that's what they're going to want. That's really what's going to incentivize them to invest in our company. But if they can't, all may not be lost altogether. There might be other reliefs that they can actually get out there, at least to help with their capital gains tax position. Now, to start with, I've mentioned entrepreneurs relief, and I've left the old name up there simply because that seems to be what everybody understands. Entrepreneurs relief was actually renamed to business asset disposal relief back in the budget in March, just to confuse everybody, I'm sure. The changes here got rather overshadowed by everything that was going on in March with the start of the pandemic. But actually, there was quite a big change to capital gains tax here, because entrepreneurs relief, business asset disposal relief, is there to give a 10% rate of CGT, as opposed to the normal 20, on certain qualifying disposals of trading company shares. And in March, the lifetime limit, the maximum relief you can have or gain upon which you get relief, was reduced from £10 million to £1 million. Now, you have to meet various conditions for at least 2 years. It's an unquoted trading company. You've broadly got 5% at least the shares, meeting various tests. But importantly, you have to be an officer or employee. And that means that business asset disposal relief is not relevant to the vast majority of pure investors in a business, because if they're not an officer or employee, then they won't qualify for the relief. Now, this wasn't necessarily felt to be entirely fair, and so a few years ago, a new relief was introduced, investors relief. And it has to be said, it does seem to be one of those reliefs which is mentioned frequently in terms of future changes and whether we need it, etc. And again, it gives access to a 10% rate of CGT. But unlike business asset disposal relief, this is a situation where somebody really isn't involved in the business. So this only applies where you are not an employee and you're not connected with an employee of this company or any other connected company. So perhaps an easier test to meet, but just because you've run out of entrepreneurs relief, business asset disposal relief, doesn't necessarily mean that you're going to be able to get into investors relief if you're involved in the company. So we still have a £10 million limit on investors relief. It only applies to more recently acquired shares, acquired after the 17th of March 2016. You've got to hold them for at least 3 years. They're ordinary shares. Again, they have to be subscribed for, just like EIS and CDIS, because investors relief is aimed at allowing unquoted trading companies to raise funds. But actually, I think it's a relief that's often forgotten about. It can be overlooked. It needs a claim in your tax return. It could be that if you've got investors, they don't qualify for EIS, CDIS, they might be able to take advantage of investors relief on a disposal of the shares. So, to summarise as we draw to a close, EIS, CDIS, really good reliefs to help tempt your investors in to invest in your company. But getting an advance assurance, if you approach it the right way, can help to satisfy your would-be investors. And it also saves work later on because it makes the EIS 1 process a little bit easier. Do watch out for the pitfalls though, especially when dealing with the cash. And I think I really would get the right advice, involve your solicitors, involve your accountants in claiming the relief, because it can go very wrong very easily. And we've got the other reliefs there if necessary. So it doesn't look as if we've got any questions. So thank you very much, everyone, for coming along today and for listening. Our next Tax Tuesday will be on the 12th of January 2021, where we'll be talking about employee ownership trusts. EOTs, as they're known, are becoming increasingly popular. Especially, I think, against the backdrop of changes to CGT, Entrepreneurs Relief, and the pandemic. They're providing quite a controllable exit strategy for business owners who are looking to move on. We're being asked lots of questions about them. So come along on Tuesday the 12th, and we'll tell you all about them. So that just leaves it to me to again thank you all for coming and to wish you a great Christmas and a Happy New Year. Thanks all.